Welcome back to the Deep Dive, where we cut through the noise of the markets to give you the insights that matter.
And today, we are definitely strapping in.
We are. We're diving headfirst into one of the most volatile corners of the financial world, the shell company sector. You probably know them as SPACs.
Right. It's a space known for just explosive, sudden movements.
And our mission today is to really get into a custom screener report from a single frantic trading day, December 9th. We've pulled out the three most explosive stocks from that day. They're all U.S.-based financial sector shell companies, high volume, and trading over $10. AFJK, HSPO, and ATMV.
And these tickers didn't just move. They absolutely exploded onto the news feed.
But we're going to unpack the whole story, the basics, the financials, which are often contradictory.
At the least.
The exact news catalysts, and of course the technicals that, sort of lit the fuse.
And this sector is such a critical case study for anyone trying to learn this stuff.
Why is that?
Well, because in the world of shell companies, price is often just. It's detached from normal valuation metrics.
Okay.
It's driven by these binary events, a merger deadline, a shareholder vote, or, as we're about to see, just the sudden removal of catastrophic risk.
So you're not trading the company as it is.
Exactly. You're speculating on a future company. Our whole goal here is to connect that frenzy you see on the charts to the cold, hard context in the news.
And to make the sheer scale of this volatility real, we're going to apply a little paper money simulation.
Yeah.
We'll use a hypothetical $5,000 for each stock.
Which should give you a really clear sense of the profit or the loss that traders might have seen on that one day, December 9th.
Before we jump in, though, let's set the stage. What exactly are we talking about when we say shell company?
So the sources define them as special purpose acquisition companies, or SPACs.
Blank check companies.
Blank check companies, that's right. Their sole purpose is to merge with or acquire another business. And all three of these, AFJK, HSPO, and ATMV, they all fall under this exact structure.
And just one quick note for you.
Yeah, this is important. This entire analysis is purely for educational purposes, based on the data we have.
Right.
And the investment scenarios that we talk about are just simulations. They should not, under any circumstances, be taken as actual investment advice.
With that said, the one thing all three had in common, the thing that just screams speculation, is volume.
Massive volume. But the scale of the move in our first stock, AFJK, is, well, it's something else entirely.
Let's get right into it then. AFJK, Aimei Health Technology. This is the one that really defines extreme.
It's the total outlier.
So if you check the market at the close on December 9th, you saw a price of $88.50.
And the wild part is where it came from. That was an $80.29 move in one day.
It works out to a daily percentage change of, and this number is just staggering, 977.95%.
Almost 1,000%. It's not a rally. It's
a market supernova.
Exactly. And when you see a spike like that, you know the catalyst has to be existential.
So what was it?
The data's clear. News broke that day. SPAC deadline extension alleviates liquidation risk.
Okay, so they weren't going to disappear.
Right. The news initially reported it as driving a 48% surge. But the market's reaction, it just dwarfed that initial number.
So the news wasn't we're making a ton of money. It was we're not dead yet.
Precisely. And that's all it took.
And that's where the numbers get so interesting, right? Because the company has a solid market cap, over $500 million.
Right. $527.87 million.
They actually show a small profit.
Yeah.
An income of $1.41 million. Positive ROA, positive ROE. But the valuation.
Forget the valuation. This is a perfect example of speculation just completely overwhelming the fundamentals.
Yeah.
You mentioned that small profit, but the market doesn't care about $1.4 million when the PE ratio is 439.
439. Wow.
And a price to book of 12.9. This isn't about current performance. It's purely about the fact that the liquidation clock got paused.
So the hope for that massive future merger is suddenly back on the table.
Back on the table in a huge way. And the technicals, they don't just signal a fever pitch.
It looks more like a market breakdown.
It's peak euphoria. The single most telling metric is the relative strength index, the RSI.
The 14-day RSI.
It came in at 93.64.
And for context, over 70 is already considered extremely overbought.
Extremely. So at 93.64, it tells you the buying was completely exhausted probably irrational. Anyone trying to short that momentum was just getting run over.
And the history shows how explosive it was. The price is now over 100% above its old 52-week high.
And over 1,200% above its 52-week low. It's just a new paradigm for the stock. The closing candlestick was a Morobozu white.
Which means?
It suggests buyers were in complete control right up to the final bell. Almost no selling pressure at the top.
Okay, let's do the paper money simulation. Let's track that $5,000. Imagine you were positioned correctly and you invested $5,000 at the previous day's close, which was $8.21.
Okay, so that entry point would get you roughly 609 shares of AFJK.
Now, if you decided to sell those 609 shares at the close on December 9th at $88.50,
your total value would have skyrocketed to $53,900.50.
So a $5,000 investment turns into nearly $54,000 in one day.
That's a paper profit of $48,900, a 978% gain.
That is the raw power of a SPAC avoiding disaster.
Absolutely intoxicating and also terrifying.
Okay, so if AFJK was the story of avoiding catastrophe, let's pivot to our second one.
HSPO, Horizon Space Acquisition Corp.
This one is a different story. It's about pure, unadulterated speculation, driven by noise.
Right. It closed at $17.50, which was a big 42.28% jump. But the source of the movement is totally different.
And the source material is really clear on this.
Very clear. The news report explicitly says, retail momentum in small-cap SPACs drove the gain amid social media trader buzz.
Social media buzz, we've heard that before.
We have, and the technical data backs it up. The relative volume was insane at 427.60.
So volume was over 4 times the average.
Yes. That is the unmistakable fingerprint of a herd of retail traders all moving at once.
How common is a volume spike like that, and what does it mean for stability later on?
It's rare to sustain it, and that really highlights the danger. HSPO has a tiny market cap, only $42 million.
So it doesn't take much to move the needle.
Exactly. It takes a lot less cash to push the volume 400% above average on a small stock like this.
What's so fascinating is the tension here between that immediate buzz and the long-term reality for the company.
Yeah.
Because while the traders are all excited, the company has other news, like a voluntary delisting from the NASDAQ.
Exactly, and that's a huge point. The past structural challenges, like a delisting, they just become secondary to the immediate momentum.
So for that one day, it's all about the volume and the chatter.
Right. They're ignoring the fact that the company's structure is undergoing pretty significant and not very optimistic changes.
And the valuation?
The PE is high, 132, and the PB is 4.23. But it does show some positive metrics, like ROE. Technically, it was definitely overbought, but not like AFJK.
Not at that 93 RSI level.
No, the RSI was high at 83.02, which confirms the strong buying. But the weekly volatility was much more contained. This wasn't a panic. It was synchronized enthusiasm.
A clean, momentum-driven trend.
Very clean. Performance over the quarter is up 47%, and the price is already above the 52-week high.
All right, let's track our $5,000 through this one. You invest $5,000 in HSPO at the previous close of $12.30.
Okay, that would get you approximately 406 shares.
If you sell those 406 shares at the close of $17.50,
your total comes to $7,105.
that's a solid paper profit of $2,105.
A daily gain of 42.1%. Still a fantastic day.
But the point is clear. That 42% came from volume and momentum, not from a belief that the company was, fundamentally solid.
Not at all. It was a trade, not an investment.
So we've had irrational survival and pure noise. Now for our third stock, ATMV.
AlphaVest Acquisition Corp.
This one is the cautionary tale. It closed at 10:30 for a 31.30% gain.
A positive close, yes, but the context here is full of red flags.
And it had the highest volume of all three, over 12.5 million shares traded.
And that volume, in this case, it signals something very different. It signals institutions and sophisticated investors running for the exits.
How do we know that?
The news tells us directly. The negative driver was a report. Higher redemption rate in SPAC merger closing triggered pre-market plunge.
And redemptions mean what exactly?
It means the professional money, the institutional investors, are choosing to get their cash back instead of holding shares in the new merged company.
It's a massive vote of no confidence.
A huge official one.
So the institutional money is fleeing. what were the insiders doing while all this was happening?
They were cashing out. The insider trading data here is critical.
Okay.
Insider transactions are flagged at negative 11%. Specifically, a 10% owner, Harrod Circle Investments, was selling.
When?
Making large sales on December 9th, the 8th, and the 5th, right into the volatility.
So the people who know the company best are getting out.
Aggressively.
Yeah.
They used that retail-driven price spike as an opportunity to liquidate before the weight of those redemptions really crashed the price.
And fundamentally, the company's in trouble.
Deep trouble. I mean, we could list off the numbers, but the summary is simple. EPS, income, ROA, ROA.
All negative.
All deeply negative. The EPS change quarter over quarter is down over 1,000%.
1,000.
This signals profound structural issues. And while the stock was up on this one day, the longer-term trend is awful. Performance over the quarter is down almost 19%.
And it's way off its highs.
Yeah. It's trading 75% below its 52-week high of $42. Even the daily candlestick, a doji, it suggests a huge battle, total indecision.
Okay, so let's use this one to illustrate the risk.
The flip side of the coin.
For the simulation, we'll assume you chased the hype earlier in the year. You invested your $5,000 near that 52-week high of $42.
Okay, so at that much higher entry point, your $5,000 would only get you about 119 shares.
And if you held on, hoping for a comeback, but were then forced to sell on December 9th because of all this negative news,
selling at that close of $10.30.
your shares would now be worth just $1,225.
That's a paper loss of $3,774.
A 75.5% destruction of your capital. It's a perfect demonstration of what happens when the institutions pull the rug out.
And that's the risk in this space. The moves are violent in both directions.
So putting it all together, what does this tell us?
I think it provides three really crucial lessons about volatility in this space.
Okay.
AFJK shows that just avoiding an immediate catastrophic risk can create this irrational speculative fervor.
HSPO taught us that massive retail momentum, social media buzz, can drive a stock, even if there are negative signals, like a delisting in the background.
And ATMV confirms that high volume can be a terrible sign when it's combined with insider selling and redemptions. It signals institutional flight from a crumbling structure.
So the big takeaway for you listening to this is that a technical indicator, like a 93 RSI or a 400 relative volume, it's pretty much meaningless on its own.
Absolutely. You have to connect it directly to the news catalyst.
In these low-float, high-volatility SPACs, that 900% jump could be the start of something amazing.
Or it could just signal that they dodged an immediate bullet. We've got to understand that distinction to even begin to evaluate the risk.
Which brings us to a bigger final question.
Right. If we connect this to the whole purpose of these companies, what is it?
It's to create a stable, valuable business through a merger.
Exactly. So if the stock price is swinging like this 900% up or 75% down before that combination is even finalized, what does that volatility really signal about the stability and the true long-term value of the future business?
That's a great question.
You have to ask yourself, when these companies finally stop being speculative vehicles and become actual operating businesses, what new stabilized information will the market demand before it treats them as anything other than a high-risk gamble?
That is the ultimate test. And that's the thought we'll leave you with today.